Good evening, everyone. Thank you for showing up tonight. We're going to be discussing how to pay for college and choosing the right student loans. Tonight, my guest is Angela Colatriano, who is the Chief Marketing Officer of College Ave. And before we officially get started, a few kind of housekeeping things. One is always love that if you guys can share where you're from in the chat, what year your student is in high school. We actually invite families that have 12th graders, 11th graders, 10th graders, but majority of the people who tend to show up tonight live are families with seniors. So if you want to share, you don't have to share where your student is going to college, but if you just at least want to share that, that they've made a decision, that's kind of nice to know. And then just in terms of the how we run the session, this is actually a Zoom meeting, not a webinar. And I only say that because, and I just saw it happen a little bit, is that people can actually, you can unmute yourself if you really want to ask a question. But if you don't have anything to say, or at least you don't want to say it verbally, please keep yourself muted so we don't hear background noise. And of course, put any questions you have in the chat. I'll be looking at the chat as we go through this. We have slides we like to use. I'll look at the questions. A lot of times I might know that Angela's going to address that a little bit further on, so I might not ask her. But if it's something that is relevant to what we're talking about, I will definitely share the question, and we will also look at the questions at the end of the session. So with that, actually, before we even get a little further, I just want to share a little bit about College Ave and thank them. They have been a longtime partner of Road to College. College Ave has been a strong supporter of our mission, and also their mission, which is to educate families about financial aid, paying for college and student loans, and their commitment to providing clear and helpful information makes them a really valuable partner to us and to you in the helping families make informed decisions about college and college costs. So we're always grateful for their support and their partnership. And as Angela and I spoke a little bit before we got started, actually going forward in the world of higher education and financing, families are going to need a lot more even understanding of things, of how the system is going to work. But with that, I'd love to at least get started with Angela. If you can introduce yourself, Angela, and we'll talk a little bit about what we're going to discuss tonight.
Well, I'm off mute, right? Yes. Okay. Yes. Well, thank you, Debbie. I am so happy to be back again. Love doing these sessions with you. We love the forum that you present and really being able to share valuable information with everyone. College Ave is one of the top private student lenders in the country. And it's everything we do. We are completely dedicated to students and families and helping them in their financial journey. So I think I don't know if I could do a better introduction than you did. I may have to have you write that down for me. So thrilled to be here with you. Before we do dive into the content, I thought I would also just sort of address the elephant in the room a little bit, that clearly there is a lot of noise in the media right now about potential changes that could be coming to higher education funding on the federal side in the coming years. I wish I had answers. I don't think any of us have answers right now. There are more questions than answers. And so just to ground everyone, what we're going to focus on today is really going to be the current program, the current rules that are in place, and all of this is what we expect to be in place through at least this summer. While again, I know probably the majority of folks that are on here are thinking about paying for college in the fall. We often see a lot of ingoing freshmen, so you're looking to pay for that first semester in the fall. And so we're really going to talk about how the program exists today and what would be in place for the 90-day run or so in front of us as you're paying for those upcoming semesters. The one thing I will say is that there are, change is probably coming. Some form of change seems likely to be on the table. So I would certainly encourage people to start to educate yourselves about what proposals are on the table, monitor how those are progressing, and then that will also help you be prepared that if there is a final change that's made, that you'll have an understanding of what that is and you'll be able to prepare effectively. So hopefully, we can at least give you information today in depth about the current program.
Okay, so let me share slides and we'll get going. Okay, wait, I have to do one thing. Okay, am I sharing the right screen?
Yes.
Okay, great. And let me just get the chat going. Okay, so as Angela already started to discuss, just the topics that we're going to cover tonight are different sources of where you can get money to pay for college, a basic understanding of the current student loan landscape, both federal and private student loans, and also talk to you and really teach you how you might start comparing and understanding when to take a federal loan and when to take a private loan. And if you're going to take private loans, how do you even compare private loans? And then how much should you be borrowing, and what does this process look like of applying for student loans and accepting them, and what's the time frame? Because that's always a big question. When do I need to get started? How much time do I have to get this done?
Perfect. Well, let's jump in with the different sources of money, the way that people tend to sort of put this together, because it's often not one solution. It's a combination of solutions to pay for college. So the categories, we've saved money here: personal savings, 529 plans, Coverdell's. The one other piece that I'd probably put in this category that's not necessarily on the page is certainly cash flow. So anything you could pay from, money in your paycheck week to week, essentially. I would also put that just in the what you can cash flow or what you are pulling from your savings. Then there's free money. This is money that you're not going to have to pay back. So scholarships, grants would fall into this category. And those could be private scholarships, or they could come from colleges. The reality is that most of that money does tend to come from the schools themselves. But certainly, I would encourage everyone to pursue private scholarships as well. And then finally, you have borrowed money, and that's money that you're going to have to pay back. And the categories, and we're really going to dive in much deeper here today, are federal loans that are completely in the student's name, federal loans that are completely in the parent's name, and then private loans, which are often in a combination of both of those. So we'll go into much more depth there. So I like to show this just because I think it is that helpful example of there is not one way to do this. It is a puzzle that people are often putting multiple pieces together to find the best way for them to pay for school. So that's really, the main thing I would focus on here is that people are looking for a number of ways, and that there's not usually one solution. It is a combination of solutions. This is just a helpful data point. This is certainly not, will not apply to everybody, but from the research that we've done among parents who are using, again, that just regular income, that regular cash flow and savings, they're contributing about $23,000 a year from their regular income and savings. That's not to necessarily say that that's what you need to do. That's not to necessarily say that that's what is right for you, but I think it just helps you, maybe as if you're not sure where to start, or if you're not sure what to even anticipate, it can be a helpful data point for you that that's what parents are reporting to us. Okay, and then finally, we get a lot of questions about this: how much to borrow? So first, let's start with cost of attendance and what is in the cost of attendance, because that's a really common question we get. Tuition and fees is sort of the obvious one on the table, but then also room and board. And another common question we get is, what about off-campus housing? Yes, you can borrow to cover both on or off-campus housing. We'll talk actually a little bit later in the presentation, as we get into sort of the tail end of the process here, about how that works if you're borrowing for off-campus housing, but absolutely that would be incorporated into the cost of attendance. Also required books, required supplies. That could include things like a laptop, as well as personal expenses, specifically travel is a key one there, that there is some level of travel that is typically baked into the cost of attendance. The school is who is going to calculate that. So they're going to take all of those categories, they're going to put them together, they're going to look at your student, their program, and they're going to calculate what they deem to be their cost of attendance. And then what you want to do is, once you have that number, you're going to subtract your financial aid. So that gets into, again, those scholarships, grants, work study, the things that you don't have to pay back. And that leaves you with, what are you covering? So again, most people usually start with income and savings first, and they figure out what they can cover from those sources. And then you get into the federal and private loan conversation if borrowing is the right answer for you. One thing before we dive into the various types of loans is, a good rule of thumb is generally that to think about what your student is going to make in their first year out of college. So think about what they're going to college for. Give some thought to maybe where they're likely to live. Just give a little bit of projection on what you expect them to be doing. Because if they can borrow less than they're going to make in that first year out of school, it generally sets them up to be able to repay that debt in 10 years.
Angela, we actually have two good questions right now.
Sure.
Somebody is asking that they learned that the University of California includes in the cost of attendance traveling to visit family. I'm assuming that that might mean, like holiday time. Is that common?
That's what I would assume as well. So yes, it doesn't necessarily expect, what they usually do is bake in some standard holiday travel or end of term travel. So for example, they may go back home at the end of the fall semester and then return for spring. They're certainly not baking in, for that example, they're not baking in something like a once a month flight home or that level of frequency, but they are typically anticipating, travel a few times a year around the beginning and end of semesters.
And then there was another question from somebody whose student is going not to a study abroad program. And now so many colleges actually, a student can spend their first semester or first year at, it's a campus of the college, but it's international. And so how does that fit in with cost of attendance and borrowing?
As long as they're enrolled through that college, so they are a student of the college that's here in the United States, they'll do that calculation as well. So it's still going to include essentially their math around their cost of living in that country for that program. It's going to include supplies they need for that program. In terms of travel, my guess is that it probably doesn't expect as frequent trips. So it may just be at the beginning of the program and the end of the program. But my advice on that front would be to speak directly to the financial aid office for a little bit more clarity if you're concerned about how they're going to calculate the cost of attendance for that specific kind of program. What I can tell you again is that as long as they are enrolled in that program through that US based school, so I'm just going to sort of throw Penn State out there as sort of an example. As long as they're traveling abroad and studying abroad, but they're enrolled through Penn State, then they can still use federal loans and private loans. They can still borrow to cover that expense. If they were attending a university that was not a US presence, they're enrolling directly in a foreign university, there's different rules there.
Somebody has a question, and maybe this wasn't clear enough to them. They're saying, how do students use the money allotted for personal expenses and travel if it's counted in the cost of attendance? I think they might not understand that this is kind of, this is a number that the college has used to determine how much you can borrow.
That's right. So this is how they use it comes down to, I think what you're asking is how they can actually access the money.
Right.
I think we might want to cover that towards the end of the presentation. It just ties into a few other pieces of content that are there. But essentially the school will pass the funds along to them and then they will be able to spend it, but we'll get into more depth with that at the end of the presentation.
Okay.
Okay, so student loan options. We'll dive deeper into this piece of it. On the federal loan side, there's essentially two types. There's the direct loans. Some people will still refer to them as Stafford, but that's somewhat dated terminology at this time. Direct loans is really what you typically hear. Those are the loans that students can get in their own name. They're usually the only student loans that an undergraduate student can access in their own name without anybody else assisting them. They tend to have the lowest fixed rates that are going to be available at any given point in time. And they do tend to have some special loan benefits. Like right now, there are some income-based repayment and loan forgiveness programs that are attached to them. The key piece with those, they are always where you want to start. The key piece with those are that there are annual borrowing limits, which often will not cover the full cost. So it's always the thing you want to exhaust first, but it's not necessarily going to cover the full cost. That's where Parent Plus loans and private loans can then come into play. So on the Parent Plus loan side, I'm actually going to come back to the origination fee piece. So on the Parent Plus loan side, they have to be solely in the parent's name. And I really am using that terminology specifically because there are some other, there are quite a few restrictions in terms of who can take a Parent Plus loan. There are some guardianship rules. If that applies to you, I encourage you to go to studentaid.gov to look at the details. But it is intended to be fairly narrow and to aim at the parent of the student to take that loan. They will allow you to borrow up to that full cost of attendance. They don't have that same annual borrowing cap that the student is going to have on the direct loan side. So the Parent Plus loan can go up to that full cost of attendance, which is why we described on the previous slide, everything that rolls up into cost of attendance. And then they do have some repayment options where you could defer payments while the student is in school, that type of thing. So there is some flexibility around repayment on that side as well. Coming back to the origination fees, the one thing I do want to hit is that all of the federal loans do have origination fees. I think we addressed them, correct me if I'm wrong, Debbie, I think we addressed them in a little more detail later in the presentation. But it is an important distinction before I jump over to the private side, because the federal loans will have an origination fee. The private loans generally do not. It's always a good thing to double check, but it's not common at all on the private side to see an origination fee. What you will, sorry,
No,
go ahead.
No, go ahead. I'll ask after.
Okay. What you will see on the private side is that you are going to be subject to a credit and an income review. Essentially, as a private lender, we have to be able to justify that we have vetted a person's ability to repay that loan. So it's important for us to go through that process in order to be able to meet those requirements that we have on us as a private lender. Private loans also will let you borrow up to the cost of attendance. So that's where they're very similar to the Parent Plus loans. On the private loan side, undergraduates are usually going to need a cosigner. So again, we are subject to requirements that we have to look at that individual and we have to be able to prove why we believe that individual can repay a loan, and they need to be able to repay it immediately. Students just typically don't have the current income or the credit history to be able to evidence that. So we need a cosigner to join the loan with them. And we're going to talk a lot more about cosigners, but this is just at the highest level, how to think about the differences of the sort of two flavors of federal for student and parent, as well as the private arm.
There was one quick question about the Parent Plus loan. Is it in both parents' name or just one parent?
So my understanding, so each individual plus loan is in the individual parent's name. You would not have both parents on a single plus loan. That said, there are ways for divorced parents to each take out their own plus loan. My advice is that if you want to do that, definitely talk to the financial aid office, because I understand it can sometimes be, the process is just not necessarily designed for it. It's possible, but it can sometimes be tricky. So you just want to communicate if that's going to be the plan, that each individual parent is going to take a plus loan.
And you're saying that if two divorced parents want to take out a Parent Plus loan in the same year.
Correct. In the same,
it's not as complicated as if one parent wants to take it 1 year and then they switch off and a different parent, divorced or not divorced, takes it the second year.
That's exactly right. Okay, we're going to drill one layer deeper. So on the previous slide where Debbie had federal loans and we had the direct and we had the Parent Plus, there's actually then below the direct loans, there are two different kinds of direct loans that the students can get. We'll start with the subsidized. The subsidized is the less common of these two. The majority of the direct loans that are issued are on the unsubsidized side. But on the subsidized side, what makes them subsidized is that interest is not charged while the students are in school. So interest will not begin accruing on those loans until the student drops below half-time enrollment. This is the space where there is a need-based component to this. So it's going to depend on the household's financial need, the household's financial need relative to the cost of a specific school, and how that also compares with other families who are applying to the school at the same time. So this is a very, it's specific to the individual family, and it is specific to the individual family applying at that school, whether you will qualify for a direct subsidized loan. So what that means is that you could get an offer from one of your schools and it may include a subsidized loan in your award letter. You could get an offer from another school and it may not offer you the subsidized loan, because it is that combination of household and school that is going to determine whether you're eligible for that. And the individual school will communicate that if you qualify for the subsidized loans. So you would find out from them, and you would also find out the amount. We're going to get into some of those, the annual limits later, and we'll talk about the different annual limits for subsidized versus unsubsidized. But that's essentially the highlights there are subsidized, no interest while they're enrolled at least half time, and that there is a need-based component in determining whether you will be offered that. On the unsubsidized side, this is the place where really, a lot of times we hear from families, well, I didn't fill out the FAFSA because I'm not going to qualify for anything. Virtually everyone will qualify for the direct unsubsidized loans. The most common reason that I hear when people don't qualify for them is that they're not enrolled at least half time. But the vast majority of people will qualify for that. It is not based in any way on your household income. It is just based on whether or not you have a gap to cover at the school, whether you have a cost of attendance that the school hasn't given you a full scholarship, whether you have, unmet financial need at an individual school. On the unsubsidized side, the interest does start accruing immediately when the money is issued. So as soon as the money gets sent to the school, interest is accruing on that loan. Again, when I say they're not considered need-based, they're not based on your household need. They're not based on your income. They're not based on anything along that line. If you are a dependent student whose parents aren't eligible for the PLUS loan, that's a space where sometimes you can get a little bit additional direct unsubsidized loan funds. That's a place, again, where I would say if that does apply to you, or if you believe it might apply to you, and we're going to talk about parent in a minute so you can figure that out, studentaid.gov for all of the detail on that portion of it.
And just to emphasize, because somebody just asked, the loans that Angela just described are from the federal government. So these are federal
Yes.
loans. They are not from private lenders. And
these are the federal loans in the student's name.
Right. And that's why they're associated with the FAFSA.
That's right.
There was one question. I think it applies to these loans, or honestly, maybe any type of student loans. And that is, can a student or a parent start paying off the loan sooner? Like, can they start paying while the student is in college, and can they finish paying faster than what the original term might be?
Yes, and we always encourage people to do that. There are no prepayment penalties. So I know some people may be familiar with that from other financial products that you've had. Prepayment penalties are not common in the student loan space. They certainly don't exist on the federal side. And again, on the private side, it's always good to double check things like that, because lenders could have their own rules, but they are not common. So for the most part, absolutely, not for the most part, yes, absolutely. You can start paying. There will not be a penalty for doing it early. What I would say on the federal side, because the federal loans, just the natural way that they come is that they are deferred. And so no payments are due on these direct loans until the student drops below half-time enrollment. And what that might mean is that you might have to do a little bit of homework to find your servicer so that you know where to make that payment. But that's not that hard to do. Pulling your credit report can be an easy way to find that. There's certainly, you can log into the federal website, find out who your servicer is. There's a number of ways you can do that, and then you would be able to make those payments.
And Angela, not to add a little bit more work to what you just said, but I think if you don't mind explaining, I think people might not understand what a servicer is.
Sure. So these loans that we're discussing, they're federal loans. So the money is coming directly from the government. The government does not have call centers or people who are prepared to take, help you understand what you need to do or send you statements or things along that line that are, just sort of necessary functions of communicating on the loan, servicing the loan. And so they contract with various parties to serve the federal loans. So there are a number of different, that's why when we refer to servicers, you could have a number of different servicers. And there have been a number of different ones over the years. Some of you might be, familiar with them from your own loans. They change over time. But there are a variety of companies who do the servicing for the federal government on a contract basis. I think there was one question about dropped halftime enrollment. Let me just quickly, whether you're enrolled halftime or full-time is dependent on the number of credits that you're enrolled in at the school for that given semester, or that given semester. And so the federal program, in order for the loan to stay deferred or in order for the subsidized loans to continue to be subsidized, require that you maintain more than halftime enrollment. So you have to be taking enough credits to be enrolled more than halftime. And if you have questions beyond that, I would say definitely talk to the financial aid office to understand what those requirements are in terms of the number of credits that you need to make sure that they're taking.
Oops. Oh, sorry. I skipped ahead by accident. Okay. We're here on limits for undergraduates.
Perfect. Okay. So we talked a little bit about, certainly the direct loans for undergraduates are the first ones. If you're going to borrow, those are always the first ones you want to exhaust. And if you're eligible for subsidized, you want subsidized first and then unsubsidized. But we also talked about the fact that there are often limits that are low enough that they may not cover your full cost. And then that's when we start talking about the other loan types. So I'm really going to focus on the dependent undergraduate column here. My advice on the independent undergraduate column is that most students will not qualify as independents. It is not as simple as I don't claim them on my tax returns anymore. There are some stricter requirements around how a student could fall into that column. So my advice is studentaid.gov, search for independent student if you want more detail about that. But I would focus on the dependent undergraduate since that is the majority that most people will fall into here. And as you can see, the way that this is, again, I do just want to stress, this is the way this works today. This is one of those pieces that you are going to want to pay attention if changes should come in later years. But this is the way the program is designed today. This is what will apply for anything that you're going to be taking out in the summer of 2025. So freshmen can take up to $5,500 in the direct loans. Only $3,500 of that could be subsidized. If you qualify for subsidized, it will never be more than $3,500 of the $5,500. And that would apply, by the way, to all of these other years as well. It's a subset of that amount that could be subsidized. Again, studentaid.gov if you need the detail there, but understand the concept. You can see that as the student progresses in school, they can take more each year. That's again based on credits, not necessarily the fact that it is their second year. It is based on have they completed enough credits to be considered sophomores, or have they completed enough credits to be considered juniors. So you can see that they can borrow incrementally more each year as they progress through school. And then there is a lifetime max that is applied to the program. What I would highlight here is that you can't go back. So if you don't take the $5,500 sophomore year, or I'm sorry, freshman year, you get to sophomore year and you say, the $6,500 really isn't enough. I'd rather have more like 10,000. You still, even though you didn't access the funds freshman year, you can't take more than $6,500 sophomore year. What am I missing, Debbie? On that portion, then I can go to interest rates. Anything I'm missing?
Honestly, no. Sorry, I was answering a question, but nope.
Oh, I'm sorry. I thought you might have a question. I think I misread you as you were answering the question. Let's talk about interest rates and origination fees then. So the rates on these loans will always be fixed for the life of the loan. So if you take a loan out this summer as a freshman, you get your $5,500. You're going to get an interest rate assigned for that loan. It's not going to change for the entire life of that loan. That said, the interest rates reset every year. So if you take a loan again in the summer of 2026 for your next academic year, you're going to get the fixed rate that has been set for that year. And the rate actually gets set, we're coming up on it now, will technically get set in May. It'll probably be in the news in late May. It's based on the yield of a treasury auction in May. So that information will be coming out shortly for what the loans are for what the rates are going to be set at for this year. And the origination fee on the direct loans is relatively low at 1%. We'll talk about it's meaningfully higher on the Parent Plus loans. It's relatively low on these direct loans at 1%. The key thing I would like to talk about with the origination fee here, though, is that it is rolled into the dollar amount that you borrow. So let's just use that freshman at $5,500. If you want to take that full amount, you won't actually get that full amount. 1.057% of that will actually be the origination fee. And it will just be bundled into your loan. And so the school will not actually get the full $5,500 to cover your costs.
So just keep that in mind, because sometimes that throws people off, just like the math, you know, like they kind of question, like, why don't I have enough to, why haven't I borrowed enough to really cover this? It's because that, you know, in this case, you know, that little over 1%, it's being taken off
Yes.
as a fee. It's a bigger percentage for the Parent Plus loan. You know, I really apologize, Angela, I was answering a question. I don't know if you emphasize this. This is one thing I always like to emphasize,
Sure.
that you can't, if you and your student decide that your student isn't going to take the federal loans 1 year, you cannot go back
I did.
Okay, catch up. Great.
Yes.
Okay,
No, you're good.
Okay, but
One
there is
question.
actually a good question here. I don't about 5 years. This person said that their student is going to be in a 5-year program. How does that relate to the
Yes.
loans?
So they would be able to take, assuming again from a credits perspective, but they would be able to take the $7,500 for that 5th year, up to that lifetime max of $31,000. So that's why when you see that column under dependent undergraduate and you see what we have listed, it doesn't quite add up to 31,000. They can access up to 31,000 in their lifetime, and on an annual basis, once they get to that junior level, whether it's their junior, senior, or 5th year or 6th year, even theoretically, they could get $7,500 for that year.
And just to emphasize, there's somebody that's saying that we're saying that they should accept what they're offered to subsidized, unsubsidized loans if they need to borrow. That's what they should max out those loans first. And they were also just kind of confirming that there's no going back, meaning
Yes.
if they don't take it 1 year, the next year you can't say, oh, I want this year's amount and last year's because I didn't take out the loan last year. It's you can only take it out in the year that your student is in and the amount that you're allowed to.
That's right. Okay, so let's just re-hit some of these points. So again, the reason why we always say if you're going to borrow, the first place to start is with the direct loans that are in the student's name, because they generally are going to have the lowest interest rates that are available at that point in time based on the overall interest rate environment. They're going to be likely the lowest interest rates you can access. They do have, at this point in time, they do have some flexible repayment options like income-based repayment, which that particular program is not typically available on the private side. That doesn't mean that there's never any assistance available. We'll talk about that later, but it's not as baked into the program as it is on the federal side. There are some, particularly like public service forgiveness is still currently available. Again, I would say monitor whether changes are likely to come to some of these pieces in terms of how strongly you feel about them or how much you are planning to rely on them, because there could be some changes coming on that front. And you do have to think about those annual borrowing maximums, because again, they're just often not high enough to cover that full cost. Okay, so let's dig into the other piece of the federal program, which is designed for parents. So parents with undergraduate
Oops,
Parents
sorry,
with
go ahead.
undergraduate students who are enrolled at least half time can receive it. Again, there are some nuances around guardianship that if that applies to you, go to studentaid.gov and look, but generally it is very narrowly designed for parents. Undergraduates are not on the hook for this loan. So we often hear about people making an agreement with their student, an agreement that the student is going to pay the loan back. But legally and in terms of whose credit bureau it is going to show up on, it is the parent. It is not the student. They are not on the loan. The loan can't be transferred. There's not really any type of federal consolidation program or transfer program or anything that is easily designed to transfer that debt to the student. Sometimes there are refinancing options available. I caution people to rely on that because it has not been consistent. It is not consistently available. So I just sort of caution people to rely on that if you're thinking about trying to transfer that debt to the other person from a legal perspective. In terms of how you receive the PLUS loan, so it just like the direct loans for the student, everything starts with the FAFSA. I can't encourage people enough, by the way, to always fill out the FAFSA, to fill it out every single year. It's the way you raise your hand for these loans. It's also really the way you tell the school that you want to be considered for any kind of aid. In some instances, you could actually miss out on merit aid if you don't fill out the FAFSA. So that's my pitch to always the FAFSA every single year. But the PLUS loan that's the first step to accessing the PLUS loan. And then you will also need to sign a master promissory note. Schools, I think, will sometimes make that available to you in the portal, or certainly you can get there from the federal site. And in terms of the rates and borrowing limits for the PLUS loan, so the PLUS loan also has a fixed rate, but the PLUS loan's fixed rate will be set higher than the direct loans that we were discussing. Usually, there's a fairly significant difference between the direct loans that are in the student's name and the PLUS loan rate. We have the current rate in here for you around 9%. But again, that won't be set until a few weeks from now in May, and you can look for that in the news. I'm not sure that there's expected to be a lot of shifts this year, by the way. Sometimes we've seen sort of dramatic swings on these loans. Could be the case, no promises. But from what I have seen, I'm not sure that they're expecting dramatic changes this year. The maximum you can receive is that cost of attendance, which is again set by the school and based on any unmet need you have. So if they've given you scholarships, they're going to consider that need met. But they'll let you borrow up to the cost of attendance for any money that you have not already covered. And the origination fee is the piece I want to get back to here. This is where it really it matters more in terms of how it affects the cost of the loan, and it matters more in terms of your expectations of how much money is going to the school, because it is a 4% origination fee. And again, it's going to just be bundled into your loan funds. It's going to come out of your loan funds. So depending on how much you're borrowing here, it could be a more meaningful amount that you just don't sort of want that surprise that you thought it was going to be covered and you didn't factor it in to the amount that the school is receiving. And the way we typically tell people to think about it is that the origination fee, at the rate that the origination fee currently is, it adds about 100 basis points to the interest rate on the loan. So the simple way to think about that is if the current rate's 9.08, if you factor the origination fee in, it's about 10.08. And that matters if you're comparing the PLUS loan on the private side. You just sort of want to make sure you're comparing apples to apples. So it's just an easy back of the envelope way to factor the cost of that origination fee in.
Oh, and the only thing I was going to mention, you said about the FAFSA, you need to fill out the FAFSA to get access to the Parent Plus loan and to the federal student loans. You can still fill out the FAFSA. Like even if you didn't fill it out during the admissions process, you actually have until June after your student has really finished their first year of college.
It's the end of the semester where the FAFSA closes, right? Or the end of the academic year, sorry, right. Where the FAFSA closes.
So I just want to encourage you, don't think like, oh, the admissions process is finished. My student has decided where they're going to go and we didn't fill out the FAFSA and so we can't do it. Nope, you can absolutely still do it.
That's right.
And get access to these loans if you realize that you need them.
Debbie, the one piece before we I don't think we addressed the credit requirements on Plus before we jump into private.
True, right.
We may have just sort of missed that as a bullet on this slide that we should address here.
Mhm.
So on the direct loan side, the students are not subject to a credit review. So there's no credit review that's attached to those direct loans in the student's name that we mentioned. On the Plus loan side, there is a basic credit review. And then when we get to private, again, we'll talk, it's a different, more in-depth process on the private side. But on the Plus side, it is a more basic credit review that is going to happen on the parent. They're looking for things like if you've defaulted on a former federal loan, if you've already defaulted on a federal loan, that is one piece of criteria that could kick you out. Again, I would encourage you, if you think this might apply to you, go to studentaid.gov and look at their criteria. There's only a few pieces that they're looking for on that side. But the other thing I like to stress on that front is that on the private side, part of what we are evaluating, again, we're held to standards that we have to be able to evidence that we evaluated this application and we believe that this individual is in a good position to be able to repay this. That is not really what the Plus loan credit check is doing. So don't assume that they're sort of doing that work for you, and that if they approve you for the Plus loan, that it means that you can definitely afford it. You need to do that homework for yourself on the Plus side to make sure that you're comfortable with it. Okay, now we get into private student loan land. Just to back up real quick, because I think we've hammered home that if you're going to borrow, you always start with direct loans in the student's name first. When you get past that, if you still need to borrow and you get into, is it Plus or is it private? I often get the question like, which one's better? Which one should I do? There's not a better or worse answer there. There might be at an individual level, but there's not at an aggregate level like, oh, this one's always better than that one. In the same way that there is when we talk about if you're borrowing, you always go direct loans in the student's name first. So once you get into considering Plus, that's where you might want to also shop private student loans, because it's not necessarily that one is always better or always worse. It's going to be what's better for the individual once you get to that point. So private student loans are loans from exactly what they say, private lenders that help pay for school. They are very specifically designed. They have very specific regulations and disclosures around them. And because of that, you might actually find that there is a relatively limited number of private student lenders out there. So we often hear people make the assumption of, I bank with Chase, I would go to Chase for my student loan. You can't go to Chase for your student loan. They don't offer this very specialized program. So that's one thing I always like to point out to people, because sometimes people just have it in the back of their head of, this is the place I bank, I will just go to the place I always bank. And then they get there and find it's not an option. So be careful with making that assumption. And that's why it's also good. You're at a good point in the year to start looking now about who the private lenders are that are out there. Even if your credit union offers a private student loan, there's a good chance that they're actually partnering with us or one of the other lenders in order to offer it, because it is such a specialized program.
And you may not be familiar with the names of some of the companies because, you know, I'm not saying hopefully maybe you are familiar with College Ave, but College Ave specializes in student loans. So they're not doing checking accounts and banking accounts and, you know, and that type of stuff. Versus there might be a few other lenders who student loans is part of a larger, you know, financial products that they offer. So some companies you might be familiar with and others you might not. And that doesn't mean that they're not worth checking into. It's just because they are specialized in this product.
It's a specialized space. Okay, so now we get into the two types of private loans here that are going to feel somewhat similar to some of the other conversations we've had. But let's start on the student side. So here's the important differentiator between the federal loans we've talked about in the student's name and the private loans we're talking about for the student. They are almost always co-signed. So 90% plus of the time they are co-signed. And that means that a credit-worthy adult, usually a parent, but it doesn't have to be, it can be any credit-worthy adult who wants to take on that responsibility, is on the loan with the student. And it is really important to understand that responsibility. So you are on the hook for it, regardless of whether you made an agreement with the student that they're actually going to be the ones to repay it. It's going to show up on your credit report. Positive behavior will positively impact both of you. Negative behavior will negatively impact both of you. So if the payments aren't getting made, it's going to reflect on both of your credit reports. They do, much like the plus loan, typically allow you to borrow up to that full cost of attendance. So in theory, they can totally close that gap if you have anything remaining that you need to borrow. The interest rates here are not going to be one set rate. What we talked about on the federal side, everybody is getting the fixed rate for that given year. Everyone's getting the same thing. On the private side, your interest rates are based on your individual credit profile. This gets back to that why I say there is not an answer of one is better than the other at an aggregate level, that it really is what's the better option for you. Because in some cases, people have credit profiles where they can qualify for lower interest rates on the private side than they could get with Parent Plus. Generally, better credit equals lower interest rates. I'm going to come back to cosigner release just because it's a little bit more of an in-depth topic, and then I will circle back to that. We talked already about the fact that most private student loans do not have origination fees. It never hurts to check, but I'm telling you, I haven't seen it in a very long time in the private space. And you do really want to talk to the student if you guys are going into this together. This is where I really want to stress that cosigner is, they are sharing responsibility. And so it's important, I think, for the student who may have less of an understanding of what that means and how, each other's actions, whether you're paying the loan or not paying the loan, can impact the other person. And so what the expectations are, what they're, going to need to pay on that loan, what the payments will look like, and how interest rates work. It's really important to have that conversation so that they understand what's happening as well. So if we want to let's circle back to cosigner release, and then I'll jump over to the private parent loan side. So this is very, very, again, we talk about these being specialized products. This is very unique in the student loan space. If you've ever been in a situation where you had a mortgage that had two people who were on the mortgage, it is often impossible to remove somebody from that loan because it was made under the premise of both of these people are needed in order to make these payments. On the student loan side, it is a little bit different because we do understand that the cosigner is necessary upfront, because the student at that point in time, while they're in school, does not have the income or the credit history to qualify, but that the goal is obviously for them to get the utility of the degree, to get employed, and then to be able to repay that debt. So it is a unique animal. And so some lenders, including College Ave, do offer the ability for cosigners to be released from the loan. What you want to look for here is, does the lender, if this matters to you, you want to look for, does the lender offer it? Because this is a space where you may see in the private lender space that there's not necessarily one answer. Some do, some don't. You also want to look at what their criteria is. So is their criteria very clearly spelled out? Do you know exactly what you're going to need to do in order to qualify? Or is it, you can ask and it's completely discretionary and judgmental, and they'll tell you whether you qualify or not? Our policy is on our site. We do require that students be at least halfway through their term. They need to evidence income that is at least double their debt with College Ave. And then we do look for, no delinquency within a certain window of time. But it is very clearly spelled out. So you will know whether you check those boxes and when you check those boxes and whether you'll qualify or not. And then on the private parent loan side, so it's called that, I think, to try to help people draw the parallels with the plus loan, but it's almost more accurate to call it a sponsor loan, because on the private side, this, again, you can check this by lender, but in general, on the private side, it does not have the same requirements that it has to be a parent. It just needs to be a creditworthy individual who wants to take full responsibility for that loan. So again, the student is not responsible for these loans. They are not on the loans, it is not on their credit bureau. They are not legally liable for them in any way. So it does need to be a creditworthy adult individual who wants to take on the full responsibility for that loan without the student on there. But it doesn't necessarily have to be a parent. Also allow you to borrow up to the full cost of attendance. Like everything else in the private space, don't have origination fees. And it's also like the private student loans in that the interest rates are going to be based on the individual's credit profile. So it's not going to be a single price point. It's going to be based on your particular credit profile.
Is there anything you could share, Angela, just generally, like if I'm a parent and do you think I would get a better interest rate, if I did a private parent loan or if I did a student loan and I was the cosigner with my student?
There is not a hard and fast rule. So it could go either way. So if you're willing to take on the debt yourself and you're really just looking for the lowest interest rate, my advice would be to apply for both and see what you get. What sometimes surprises people is that the student loan that you're co-signing will sometimes have a lower interest rate offer than the parent loan. And the reason for that is because as a lender, if you think about it, you have two individuals on the loan. So you are increasing the likelihood that somebody is going to pay this back. So the lender is taking on less risk. And when the lender takes on less risk, they can usually pass that along in the form of lower interest rates. That is not a hard and fast rule. There are various things that can impact that. So again, don't take that as that's a hard fact, but don't be surprised if you apply for both and you see that you have a lower interest rate if you co-sign versus if you take it on individually.
And the only other thing I want to emphasize, which Angela mentioned, that most lenders, but definitely double check, have a cosigner release, and it will vary what their criteria is for you to get released as the cosigner. May definitely vary from one lender to another. So understand what those rules are, and just be comfortable with them, with whichever lender you choose to go with.
Yes. So on the private side, you will find a little bit more variation in terms of features. So these are just a few other aspects that as you're shopping, you may want to evaluate. So interest rates, obviously, that's the cost of borrowing. So certainly that's going to be your main point. The thing I would stress there is that if you are comparing to Plus, make sure that you're factoring the origination fee into Plus so that you're truly comparing apples to apples. There are sometimes ways to get interest rate discounts. A common one that you will see, this actually applies on the federal side as well, by the way, and it certainly applies at College Ave, and you will see it a few other places, is that you might be able to get an interest rate discount if you make automatic bill payments. That's an easy thing to do usually. It also makes sure that you're staying current on the loan. So it has multiple benefits, and certainly if that is a feature, make sure you sign up to do it. One thing I do like to remind people about there is you need to go through the lender's portal to set up those automatic payments. I've had people before ask if they do it from their own bank, does it count? It doesn't count in that case. You have to go through the lender's portal to sign up for those automatic payments. Cosigner release, I think we probably hit in depth there. But let's talk a little bit about the repayment options and the loan terms. So College Ave is an example. We offer a variety of repayment options to encourage and enable starting to make payments right away. We talked about that a little bit up front. Can you do that? And I said yes, and we encourage you to. Our loans actually have that built in as a feature. So we try to encourage you even to just start making $25 payments during school. It helps to offset any interest that's accruing. It helps to keep your costs down. And it also just establishes, if you think about a student trying to establish good behaviors, it helps them learn that they need to make monthly payments on the loan. So it has lots of benefits from that standpoint. We also offer an interest-only option. You can pay the interest as the student goes in school, or you could start paying full principal and interest right away. And generally, the way that our pricing works is that, and you see all of these options once you're approved for the loan, you can use our calculator that's built into the application to see the impact. But generally, if you choose to make payments right away versus deferring and not making any payments in school, if you commit to making those payments, you can usually get a reduction in interest rate. In addition, we let you pick how long you take to repay the loan. So 5, 8, 10, or 15 years. And then there's some different options on grad, but that's sort of the standard for undergrad. And the idea there is that if the shorter loan terms will help you pay less in interest, and we can often offer a lower interest rate on the shorter loan terms than we can on the longer loan terms. And if you just think about that simply, if someone applies with us and they choose to take 15 years to repay, and they're not going to start paying the loan for 4 or 5 years until they get out of school, That's a different level of risk for us than somebody who says, I'm going to start making full payments right away and I'm going to pay it off in 5 years. So that's just a really simple way to think about how that works. Our goal is that as again, sort of toggle those different choices that you have, is to try to help you minimize what you're paying in interest, but also get to monthly payments that are going to be practical for you while the student's in school and while they're out. So I just encourage you, if you're shopping in the private student loan space, to look for repayment options like that, which they are unique. They don't apply on the federal side. I mean, federal has its own repayment, but this is going to be more in the private space, where you're going to have some of these configuration options that will help you zero in on minimizing your interest and getting to monthly payments that work for you. Some lenders will not let you make all of those choices. So you may not have automatic options to pay in school. That doesn't mean that you can't do that on your own. It just means that they might not be easily enabling it, or they might not be rewarding you for it with a lower rate. And some will just assign the repayment term. So they may not say to you, let me give you, again, an easy way to do this and set this up for you to repay it in 10 years. I'm just going to assign you 15. So you do want to evaluate that as you're shopping in private lenders.
And can you change any of these features? Like, for example, I might have initially taken out the loan with 5 years, but I realize I really want to change it to 7 years. Is that possible?
So let me give you a few different answers on that one. One is that I want to remind everybody that you are going to repeat this whole process every single year the student is in school. So you're going to borrow for freshman year, separate from sophomore year, separate from junior year, separate from senior year. So you certainly could change if let's say you take a loan freshman year and you start paying, you choose to start paying that one back right away. You commit to do that. But then sophomore or junior year, you get to the point where you say, I really need to defer this one because I'm making payments on the other one. Absolutely. In those different years where you're taking out different loans, you can make a different choice. In terms of if you've taken out the loan and then you have buyer's remorse or it's not working for you, it's not something that we allow people to switch in and out of constantly. So you do want to make a very thoughtful choice out of the gate. You want to try to select what you believe is going to work for you. That said, if people get down the line and they find that they just have a repayment program which is not working for them, we always encourage people to call us. We want to find ways to work with them. I would say this is generally true of the private industry. It's not good for us. It's not good for the student or the family if people are in a bad place and they can't find a way out. So there are, some options if you really get to the point where you absolutely cannot make those payments. But it's not a luxury of, well, this month I feel like this and this month I feel like that, and being able to switch easily in and out of them. Part of the rationale for that is that, we do offer those lower interest rates for a commitment to shorter terms, a commitment to in-school payments. So for us to be able to continue to do that, that's part of the reason why we can't offer people to, shift around all the time.
And when will people, you mentioned that depending on the repayment option a borrower takes and the loan terms, whether it's 5, 7, 10 years, it might be a different interest rate. When will they see like the different interest rates for these different configurations in the process?
So we have a few different tools available for before you apply, where you can get a sense of the impact of these different choices. And you can also get a sense of what your particular rate range is. So let's talk about that a little bit. We have a pre-qualification tool on our website where you can very easily go enter a few basic fields of information. Really, the cosigner is the one that needs to do it. Let me stress that, because generally the cosigner's credit is what we're basing these decisions on. So in order to get a meaningful response, the cosigner is who should fill out that pre-qualification form. But you can get a tighter interest rate range than our large published range that's more specific to you and your credit profile. So that's one piece where you can get a better sense of where you're likely to fall in that range of pricing. We also have calculators on our site. Some of them are more generic, where if you even wanted to investigate the cost of your federal program, you could go and just plug some general numbers in. They're just very generic student loan calculators. We have others though that are built specifically for our products, where again, you sort of understand that difference of, if I start making payments, how meaningfully will that, impact my overall cost? How much can I drive down my interest charges if I start doing that? So our pre-qualification tool and our calculators, I would say, are the best early shopping mechanisms. And then once you're ready, once you actually apply and you are approved for the loan, you will get something that looks very similar to our calculator, where it has your very specific interest rate, and you can play with the different options and see what your exact monthly payments are going to be, your total cost, all of those details. So your very specific offer would be once you have applied and you are approved, but we offer those shopping tools up front, which won't impact your credit, which will just enable you to kind of learn a little bit more about how this works and what the implications for you might be.
Okay, let's talk about timing.
Yes. So we're in the shopping phase right now. I do often get the question, when should I apply? And I'm really being pretty specific here about the fall semester. Certainly for those of you in the future, you can be thinking about this time of year, but for the fall semester, you can apply whenever you know what you need. Now, some people don't feel like they know that until they get the bill. The bill doesn't usually arrive until like July. And I swear I'm getting to what's actually on the slide, but what I want to stress there is that the bill itself does not usually come until sometime in July, and it's often due with a fairly short turnaround in August. And so what that means is that even if you are not comfortable applying until you know what that exact bill is, you should be shopping now. You should be thinking about your choices now, your options now, how much you can cover with the federal options, if you think you might need to borrow private, who the various private lenders are, how that compares to PLUS. You're in your 60 to 90-day shopping window right now. And what that's going to prepare you for is that if you know what you need now, or if you feel like you have a pretty good sense, you can go ahead and apply now. You are already within the window where you could apply. If you do wait, my advice is to do that shopping up front so that you're ready to apply as soon as you get that bill, because it is a very tight turnaround. And what people don't always understand about student loans, and again, why this is such a specialized product, is that all of the money, all of this really goes through the school. So once you apply with us and we approve you for the loan, we then have to send the loan to the school to certify it. And what that means is that they're going to verify that you still have an unmet need up to the cost of attendance. So they're going to verify that this loan isn't going to take you over their calculated cost of attendance when they factor in other aid, scholarships, etc. So they're going to verify you have a need. They're going to verify the students enrolled. They're going to verify, various things along that line. And then they're going to echo back to us basically the certification or the approval for that loan, and also tell us when they want the money and how. Because none of this money will come directly to you. If you're borrowing for off-campus housing, you can borrow for that, but the money will actually channel through the school, and then they will refund any overage to you that doesn't apply to their tuition fees or other things that they're billing directly. They will send that cash to you. I say cash. They will send that money to you. And so because we need to do all of those steps, and because the schools, you can imagine the amount of loans that they're processing in that July and August windows when those tuition bills have gone out and everybody is applying at once, and all of the certifications are coming in at once, they obviously have a bit of a bottleneck there sometimes. So that's why I just always encourage people to be ready. If you can apply early, go ahead and apply now. If you want to wait for your bill, just make sure you're ready when that bill comes so that you can get that process moving. And if you are borrowing for expenses that are not billed directly by the school, so off-campus housing, I keep stressing that is the key example there, but laptops would apply, books would apply. If you're borrowing for those, you do need to take into account that you're not going to get that money. You're not going to get it in July. You're not going to get it in August. You are probably going to get it in September, once the school asks us to send them the money, and then they send you any overage. And you also want to check how they're going to send the overage to you, because that's entirely up to the school. They could apply it to your student's account as a credit. They could send a check. They could hand it to you on a prepaid loaded card. They have their own ways of providing you any overage of borrowed money, and you want to know what that is and what their timing is.
Angela, you mentioned, if people know what they need to borrow, they can really, they could in theory secure the loan now. What if they thought they knew, but it turns out that either direction, maybe they need a little bit more or maybe they need a little less? What's the advice?
I would always say, I don't mean this in a way to encourage over borrowing. That's not it at all what I would say here, but I would say err on the side of applying for a little bit more versus a little bit under. And part of the reason I say that is because most student lenders have a minimum loan amount. So like we have $1,000 minimum. You don't want to find out that you're $500 short and then you are $700 short or $900 short, and then you can't access another loan. The other piece is that you don't really want a second inquiry on your credit bureau. It's much easier to just lower the loan amount after the fact, or to even say, I got $500 that I didn't need. I'm going to just send that back in as a payment immediately and get rid of it. It's easier to lower than it is to increase for those various reasons. So again, I'm certainly not encouraging anybody to take out significantly more. I'm just saying err on that, err a little bit higher versus a little bit lower. It's just usually easier to manage.
And what about, again, let's say I decide I just want to get this over with. I want to, do my research now and uh, um, get the loan, even though I don't have to pay the bill yet. And let's say I get it May 1st, and who knows, I guess either direction or maybe for the better, something happens and interest rates really go down. And now in July, it looks like, wow, I could get a better interest rate than the loan I already took out. What can somebody do?
They could reapply for another loan at that point, especially in this window. Again, what will sort of happen between now and the end of August, early September is that the application will just be in a pipeline and the money won't really go to the school until the end of August or September. I would encourage people to do their homework though, just for simplicity, quite frankly, of not having to deal with that. I would encourage people to do their homework and say, how do you feel about the rate environment? Do you think rates are likely to decrease? If you think that they are, then you should wait. That would be a better path to go if you don't feel like you want to commit in the current rate environment. That's actually often a question that we get too of whether you should borrow for the full academic year or by semester. And you have the choice of either one. So you can borrow for the full academic year or you can borrow by semester. And what I generally tell people is you sort of need to do your homework and you need to think about, do you think interest rates are going to increase or decrease? Do you think you know what you need, or do you really not have a good sense yet of what you might need for that spring semester and you really only think you know what you need for fall? There's a convenience factor in borrowing for the full academic year upfront, certainly, because you know that it's taken care of and you won't overpay in interest. Because if you borrow for fall and spring, what I mean by that is some people say, well, I don't want to borrow for spring yet because I don't want to be paying interest on that portion of the loan when I don't need it yet. But the way that it works if you borrow for the full academic year is the school will actually split it up into multiple disbursements. And when they come back to us with the certification, they will say, okay, Debbie wants to borrow $10,000 for the full freshman year. Send me $5,000 in September. Send me the next $5,000 in January. So you truly are only paying interest on the portion that you're using. Hopefully that makes sense, but that's a question that we get quite frequently. So I think most of this we've actually probably covered fairly in depth. Again, I certainly encourage people, if you can start to pay sooner, even if it's a small amount, it's going to benefit you in the long run versus deferring and just letting that interest accrue. It is really important to have conversations with the student about expectations. Who's making payments? What are the repercussions if payments are not, made? Do they understand what that payment is going to be? And that they just are fully engaged, I would say, in the borrowing process, and that the cosigner is fully engaged in the process, and that everybody knows what the responsibility that they're taking on. I do want to answer one question that I see here about, will applying multiple times lower credit scores? So in general, and this would apply whether you're shopping for an auto loan or a student loan or any sort of category, if you do your shopping within a 30-day window, it will generally only count as one inquiry at the bureau. So that's just a good practical tip anytime that you're shopping for a category of loans, is that you want to sort of shop within a 30-day window, and then the bureaus recognize what you're doing. They know you're trying to get the best offer. You're trying to evaluate offers, and so it will have less of an impact. It won't have no impact because you are applying for credit, but it will lessen the impact on your score.
And you can, maybe, I know you mentioned this, Angela, but just because you're talking about like hard credit pulls versus soft credit, explain a little bit about the pre-qualification and what happens with the credit bureaus there, and also
Sure.
what type of an interest rate they get back.
Yes. So pre-qualification is what we call a soft hit. So it will not impact your credit score. If it's pre-qualification, it won't impact your credit. It is not a firm offer of credit, though. It is usually an estimate of what you could receive, because it's not a full application. We're getting some basic information back to be able to give you a little bit more clarity so that you can decide whether you want to submit a full application, which will result in a hard credit pull. And you will get, at least speaking for College Ave on this front, you'll get a range of rates, because again, your final rate is going to depend on how long you take to repay the loan, whether you start making loans and payments in school. It's going to depend on a variety of factors. So you're going to get a range, but it's going to be a tighter range than our overall. And yes, so we'll applying for, if you take a loan in different semesters, so if you apply only for the fall and then you apply again in the spring, those will be counted as two separate inquiries. Because they will be far enough apart that the bureau will not see them as the same thing. So yes, there could be some impact on your credit there, because it would be multiple hits. Yes. So if that matters significantly to you, you might want to factor that into whether you borrow for the full academic year or by semester. And then finally, resources and tools. So I've referenced many of them already today on the call. Anything federal loans is studentaid.gov. It's your best friend on the federal loan side. They honestly there's a lot of information there, but they really have done a solid job with, it's more consumable than it was maybe 10 years ago. I can promise you that. It is very accessible. It will have answers to the things that you need. So federal wise, you want to go to studentaid.gov. On the College Ave side, whether you need to borrow or whether you elect to borrow with us or not, we do have a variety of resources available, from calculators. We have a ton of resource articles that will cover some of the same things that I discussed. So, I fully encourage you to explore that site and make the best use of all the resources. We also have a monthly scholarship contest that we run. So if nothing else, go enter to win a scholarship. It's a quick, easy form. You can come back every month and enter. It's a simple way to maybe offset a little bit of the cost of college.
Okay, so let me go through some of the other questions that we didn't get to. And I know for some people this might feel like, whoa, I just finished up the whole admissions process. Like, I didn't realize, there's like more. Unfortunately, but fortunately, there's, this is like the last phase of the process, and people just, don't always realize it, but you can get through it. It's not as, overwhelming as what you just went through. So, okay.
And I know I talk faster and faster as we go. So hopefully the recording, you can, slow me down. And
So there's a question about Parent Plus loans and how they impact, and do they show up on a parent's credit report?
Yes, they do. They're treated just like any other loan. So yes, they will absolutely show up. And as a reminder, they are only in the parent's name, so they will not show up on the student's credit report.
So somebody was asking, they said earlier in the presentation, we said that Parent Plus loans were federal and they were the cost of attendance minus financial aid. But
Yes.
then later on, we said the Parent Plus loans are the full cost of attendance.
Let me clarify there. So for Parent Plus and for private loans, the rule is always you can borrow up to the full cost of attendance minus any other financial aid that you've received. So what the school is going to do, this is part of that certification process, when they receive a request for any type of loan, they're going to look at what your actual cost is and what has already been covered by things like scholarships, that type of thing. So what cost is already accounted for. And then they'll look at whatever's remaining and they'll let you borrow up to the cost of attendance. So the rule on Parent Plus as well as private would always be, it'll be cost of attendance minus any other financial aid that they've already accounted for you.
So I was kind of waiting for this question when it comes up, because I know that there are parents out there with either twins or multiple students in college at the same time. And, what advice do you have for those families that have to, take out loans for hopefully just, for two students at the same time?
So I do think it takes it, well, I'm sure that this is no surprise to anybody who would ask that question, but it certainly takes a little bit of an extra layer of planning. And part of the reason for that is because they're in the same way that we talk about those aggregate limits on the federal loan side, which are very clearly defined. They're not specific to an individual. They're just hard and fast. There are borrowing limits in general that you could also run into on the private side. They're harder to articulate because they're not hard and fast. There's not one rule all of the time. It's often based on, well, what is your income level? So what are you able, how much can you borrow? What kind of debt are you able to support? So they're going to be based on your income, your credit, your other debt that you have outstanding. But you could run into a situation where, you sort of maxed out what you are able to borrow. And on top of that, you will have those credit impacts that we talked about, because you will come back every single year. And so you will be, you'll have inquiries, but you will also have additional debt on your bureau, which does lower your credit score. So I know that that's not the perfect advice, but you may want to think about, we sometimes hear parents sort of switching off. Like, I'm going to take this kid, you're going to take that kid, or I'm going to take freshman year, you're going to take sophomore year, I'll take junior year. And we see that, whether you certainly see that sometimes with divorce situations, but we see that even in, married households, where again, part of what they're balancing is how much debt each individual parent is taking on and the credit impacts.
Well, kind of a similar question, but for a different situation, how can people project or plan, knowing that they're going to have to take out loans for years 2, 3, and 4? Will they potentially run into any of these limits, or or they're going to have more on their credit report, and will that impact interest rates in later years?
They could. It's honestly, it's such an individual question, Debbie, that it's just very hard to answer for a wide audience. I do think that they should consider, we always try to encourage people to think 4 years out. I know that's a little bit difficult right now because we don't know what might change in the coming years. But I think the best thing you can do is just first start by, how much debt do you already have? What's your debt to income ratio? And how much are you looking at taking on over the next 4 years? And do that math and see if that looks rational.
And can private loans be refinanced? And if so, when can they be refinanced?
So yes, that's often usually, so there's sort of two flavors here, where if you're talking federal, there is a federal consolidation program, which can only bundle your federal loans. Refinancing usually refers to bundling your loans with a private lender. And you can usually put federal and private loans into that, or you could elect to only refinance your private loans. It really just comes down to what offers are available at any given point in time, and whether you meet the credit requirements to refinance those loans, because usually the refinance loans have lower interest rates. It's a little challenging because you can be at different points in time, but most often people will choose to refinance if there are refinance options with interest rates that are lower than what they're currently paying on those existing loans. So it's a little bit point in time of whether it's going to be beneficial for you. The student usually does need to be out of school. They need to have some established income, some established credit, for that to really make sense for them. Parents can sometimes do it a little sooner because, again, they sort of already have that established credit history and income if they want to refinance.
There's a question here, then this might, this isn't really apply to the lender, but maybe you'll know. Somebody's asking that the bill that they get in July, is it tend to be a bill for the full year or just the first semester?
I believe they usually give you the full year.
Yes, they will sometimes they will show you the full year, but obviously say what is.
Oh, yes, I'm sorry. They will give you a sense of what the full year is going to cost, but the bill is only
Right.
for the immediate semester. Sorry, I think I
Yeah.
misunderstood your question there. I wasn't sure if you meant, are they going to give you some idea of what the full year will
Okay, yeah.
cost?
Oh, good question. Somebody's asking, the timeline that we showed, is that only for private loans? Is there a different timeline for federal?
So federal, the process is usually already started by now because hopefully you've completed the FAFSA. If you haven't completed the FAFSA and you're interested in possibly being able to access federal loans, it doesn't commit you to that. But if you're interested in having the option to access federal loans, then you need to go do that now. But usually the FAFSA has already been submitted. And so the federal loan process is, I would say it's sort of already underway. And you will often see it in the award letters that you receive from schools. Award letters can be a little interesting to decode. That's one of those places that the resources on our website can probably help you see that. But essentially, that's the process for federal loans. So the FAFSA is what kicks it off. If you haven't already done it, do that. That will kick it off. There's a little less shopping, I guess I would say, from that perspective, because you're not, you can compare plus to private, but you're not really looking at, you're not comparing a bunch of different federal options, so to speak, the same way you are on the private side.
So somebody's asking, and I don't know, but it would be good for you guys to think about. They're wondering if there are tutorial videos on the College Ave website.
We do have some videos on the site as well, again, within our resource section. They may be directly searchable from YouTube as well, but there certainly are videos available in our resource section.
And just this is, and we said it, but just to reiterate it, somebody is asking with private loans and with federal loans, do the money, does it go directly to the school or does it ever go to the parents?
I don't know of any private lenders at this time that are dispersing directly to the student or family. That doesn't mean nobody ever does it or will do it, but I don't know of any. So I would say what you should expect is that all of the money is going to go through the school.
Here's an interesting question, but I think I know the answer, but just to confirm, can there be more than one cosigner on the loan?
No, so it is limited to, again, answering for us and also for just what's very common in the private space. It's usually just student and one cosigner on each loan. And I think there also was a question of like, you realize how many loans you're going to end up with at the end of 4 years because you're repeating this every year on the federal side and then theoretically on the private side possibly as well. They do, speaking for College Ave at least, and I think that this is probably what other private lenders do as well. They are different loans, but we try to bundle them into one billing cycle and one statement. So we do try to make that simple and easy so that even though, if you have 4 loans, you're still only looking at one statement with one due date. And it just makes it a little bit easier to manage and everything is in one place.
Do you do that as each loan is added or only at the end when they graduate?
No, as each loan is added. So
Okay.
people would have full access and we send statements even if it's deferred, we send statements so that people can see, the status of the loan and remember that it's there, that type of thing.
So there's a question about somebody who has frozen their credit.
You definitely need to unfreeze it before you apply. If you apply, you're just going to get stuck. So you will be able to unfreeze it. You will be able to then get a decision, but it will be much, much easier if you call and remove the freeze before you apply, and then you can certainly put it back on.
You answered this, but I'll answer it quickly. Somebody is saying, since you get a loan every year, are they independent of each other?
Yes, so they are, but we try to make it simple from a servicing perspective, to make it simple to see them all together, to have a single due date, to see what your rolled up payment is, that type of thing. But yes, technically they are individual loans. And if you're looking at your credit bureau, you're going to see them listed as individual loans.
Okay, so here's a interesting question. Oop, it just jumped for me. Okay, well, are private loans eligible for any loan forgiveness? And can these loans be transferred to the federal loan in order to be eligible for forgiveness under the federal programs?
No. So federal and private are completely independent and separate. Federal is coming from the federal government. It is funded with taxpayer dollars. It is a different animal. That is where there are some existing forgiveness programs today. There's obviously been some discussion around forgiveness in the news. It's all federal. On the private side, they are private loans made by banks. Again, in the same way, if you picture if you went and got your auto loan or your mortgage or credit card, they are loans that are being made by private entities, and they are not eligible for forgiveness. The federal government is not offering to have them transferred to them. They are not offering to cover the debt. So the forgiveness, when you hear about that, it is federal. It is not private.
So this next question, I hope you're willing to address it a little bit, Angela. Somebody, and I'm just bringing it up because this is actually the third time I've seen it tonight.
Okay.
Somebody's saying they're confusing Fannie Mae as a loan for student loans. As
So
a lender
Fannie
for
Mae
right.
is not a private student loan provider, or they're not a student loan provider. They're not a federal provider. Fannie Mae is not student loan related.
Right. Okay. So that's just like you're just potentially confusing a name. Fannie Mae is actually involved with mortgages. It has nothing to do with student loans.
Yes. And yes, really federal, when we talk about federal loans, if you bring any other entity's name into it other than the federal loan program or studentaid.gov, it's probably a private loan. And you can certainly find that in the disclosures. They're very, very clear disclosures if it's a private loan. But there are no other banks or entities that are federal.
Oh, okay. So somebody is just a little confused, and I know there's a lot of information that we shared tonight. Kind of trying to understand FAFSA versus the federal loans, and because they applied for FAFSA, do they have to do anything else to get the loans?
Yes, we hear this all the time. It's a little bit of a terminology thing. The FAFSA is just a form. It is nothing else. It is a form that you have to complete. And after you complete the FAFSA, it unlocks access to a variety of things. And a few of the things that unlocks access to are the federal loans. So the FAFSA is literally just a form, but it is your gateway to fill out that form. You can sort of think of it as an application to then be able to go access those loans.
And I think this might be the last question. A student is, somebody's asking, if a student goes from undergraduate to grad school, what happens with either federal or private loans? Do they start accruing, or can they continue to be deferred?
So they can continue to be deferred as long, well, let me answer. I'll answer for College Ave. Other private lenders could be different, but I would say that this is generally the same answer. Usually if you stay enrolled, you can continue to defer those loans. I would highly encourage everybody to look at what that is doing to the cost of the loan, because you are certainly continuing to accrue interest. But that, yes, you typically can defer that while you are enrolled in school, even if it's that you've moved from undergraduate to graduate.
And there's been also a few questions. I just want to clear this up about why we didn't talk about 529 plans. And so I don't know if you want to say anything. I will just say that 529 plans are handled by a different type of financial services company. And really, I don't want to put Angela on the spot for knowing that knowledge, because that's not.
We don't offer 529s,
right,
so I don't think you want me giving you deep, but I actually will give you a little bit more color on why we don't necessarily dive into that in this presentation either. I think you have to consider that kind of in the context of your broader financial picture, and to try to cover all of this information about loans as well as how to think about that in the context of the 529. It's probably just a little bit too much to try to tackle here. But yes, full transparency, College Ave is not a 529 company. And so we don't tackle that piece of it, but I absolutely encourage people to think about what the best way is to maximize, if you have that, to maximize the use of those funds in combination with if you need to borrow, etc.
Okay, it is officially 10 o'clock. I think we've covered a lot, although I'm sure there's always going to be more questions. Thank you as always, Angela. Thank you, College Ave. And we will send the recording. That was another question a lot. So I encourage you to listen to this again. There's a lot of information here. You will have questions, and to that point, people can just call College Ave or chat with just questions. You don't have to say, you don't have to think, oh, I can only talk to them when I'm ready to apply. If you continue to have questions, you can definitely reach out and try and get them answered.
Yes.
Okay. Well,
and I appreciate everybody's questions, and I appreciate the time, Debbie. Thank you.
No, this was great. Thank you, everyone. And we will see you again soon. Take care. Bye.